Hello and welcome to the Real Economy with a focus on the middle market and the economic headwinds facing it. I'm Gigi Stone-Woods and we're joined by the one and only famous Joe O'Neill of the Joe O'Neill Show, Joe Brusuelas, RSM's chief economist, and Neil Bradley of the U.S. Chamber of Commerce. Thank you for being with us. And you always work so hard to help businesses navigate these uncharted waters. And now there's more uncertainty than ever, so we need you. I want to start with this audience poll that we put out asking this question: what is the most impressive element of the one big beautiful bill, as President Trump calls it? Number one seems to be the permanent extension of the 2017 Trump tax cuts. That seems to be the winner in our poll. Second, permanent expensing of research and development, as well as bonus depreciation. The third is increase in the SALT deduction to $40,000 through 2029. And lastly was Medicaid cuts. What do you think of the audience's choices here?
Well, I think that one of the things that I think really is growth enhancing are the permanent expensing of R&D and the bonus depreciation. I think when we get down to brass tacks, that's what's going to bolster investment, which we really need given the unique policy matrix that we're now stuck in. So I'm very excited about that. And I think as we learn more about the details, and Neil's going to hit on that a little bit, I think this is going to be very informative and educational talk today.
Yeah, Joe's exactly right. When you think about what helps grow an economy, it's capital investment and the research that's going to fuel the next level of capital investment. That's always been true. I actually think it's particularly true in this moment, right? We're talking a lot about what artificial intelligence, what AI combined with robotics can actually do to improve efficiency. Those things cost money, and it's going to require retrofits and new ways of doing things. Reducing the after-tax costs of those investments is going to make those easier. It's going to lead to more investment, and that's what's really going to spur growth. And that's also true on the R&D side. Importantly, I think a thing that's been overlooked, particularly for a lot of small and mid-sized businesses, they well know that for the last several years, they've been amortizing their R&D costs. They were told this was never going to happen. Washington promised, we'll never let that policy take effect. Then they let it take effect. For even a mid-sized manufacturer, you're talking anywhere from $250,000 to $1 million net tax increase. Well, they're going to be able to get some of that money back. And so it won't work for everyone. The rules are a little bit complicated, but the ability to retroactively go back and get some of that tax increase that was applied is going to be really important. And then over the long term, those provisions were permanent, and that's good for growth.
What are other positives as we unpack this bill?
Well, you started with uncertainty is the problem right now. This removes uncertainty, right? So, we were absent Congress acting, $4.5 trillion automatic tax increase at the end of the year. Lots of debates, what's going to be in, what's going to be out, for how long, both on the existing policies, but also what new was going to come into the bill. We now know some of it really good, some of it not so good, and it all kind of depends on where you're living. But now you know, and you can get back to planning and running your business rather than checking your X updates to figure out what the latest version looks like.
And I think that the combination of the first three items that you mentioned will help offset some of the drags we're going to have from tariffs and tighter immigration. So in that sense, it is particularly well-timed to make sure that the economy keeps chugging along, albeit at a little bit of a slower pace of growth than what we all might like.
And I want to spend a lot of time talking about tariffs and the labor market, of course. But breaking down the bill, how do you think the SALT deduction is going to impact the economy?
Well, I think that it's going to impact the economy in the way you want, which is it's going to free up some disposable income, especially in middle-income households, particularly in the Northeast, in California. Even in Texas, where I live, we pay very large real estate taxes. And so on the margin, it's going to help, and that's what you want to do as you move forward again in a unique time where we're attempting to reset the global economy.
What about taxes on tips and overtime? How is that going to affect service industries?
I wouldn't read too much into the impact there. I think if you're an employer in one of those, I think it's going to actually create some complications because the way the rules were constructed, et cetera, you may have some employees who qualify under it, some who don't. It's going to be an HR challenge for some employers in this industry. From a macroeconomic standpoint, deciding that we're not going to tax a limited amount of overtime or a limited amount of tips, to my mind, doesn't really move the economic needle.
Now, we have talked a little bit about the economic headwinds from this so-called Big Beautiful Bill, but we are facing a lot of tailwinds as well. Joe, you talked about how stagflation is potentially coming in barons, but it's not going to be like it was in the 1970s. Where do you think we're headed?
All right, so we're going to enter a period here where inflation is going to be advancing at a quicker pace than growth. And that has to do with the unique reset that's being attempted of the global economy. We want to rebalance that economy and narrow the trade deficits. Well, we'll see if that happens. But as you attach the levels of tariffs, right now, the effective tariff on all goods entering the United States sits at around 11%. Now, I think it's going to end up somewhere between 15 and 17%. If things don't go well in negotiations, then it'll be above 20. So you've got a pretty big headwind that's building there that's going to cause slower growth, and it's also going to cause inflation to move higher. We expect the PCE, which is the policy variable the Fed used to set rates, that'll be above 3% by the end of the year. On CPI, 3.5%. Now, we think that there's material risk to the upside there, but this is the macroeconomic environment that we're now in. It's a lot of stagnation with a little bit of inflation. The big difference between now and the 70s is that you're not going to see a soaring of the unemployment rate. We simply just don't have enough replacement labor to meet demand for
because Americans don't necessarily want those jobs.
Well, that's part of it. The real reason, the major reason is we're retiring. The echo of the Great War and the boomers are exiting, and we don't have enough replacement population at a time when there's a public demand for a crackdown on immigration and migrant labor. You put that together, you're going to have a tight labor market that's going to have an increasing constraint put on it, and there's going to be less supply. We already can see it in the data. In the June employment report, the unemployment rate declined almost to 4%. It's at 4.1 because we had too many people exiting the workforce. And we sort of think that that's a combination of retirements, right? We don't want to overstate that, but that's part of it. And then the crackdown.
Yeah.
Less people are showing up for work. This is going to be an ongoing part of the narrative for the next couple of years.
How do you see it unfolding?
The Chamber sees it the same way from the macroeconomic standpoint. Listen, avoiding a recession is 100% good. Like, if we can avoid a recession, we should avoid a recession. We're not going to, Joe's exactly right, we're not returning to the 1970s, but it's still not going to feel great, right? When inflation's growing faster than the economy, we don't generally feel good, and we shouldn't feel good about that. From our perspective, it's particularly troubling because these are some policy choices that we're making, and we could have growth that looked more like 3% and inflation that looks more like 2% rather than the opposite. And this is a question of a choice that is being made. Joe mentioned the tariff front, for example, and the tariff levels that he just described, we see it the same way. We see tariff levels over the next 6 months being higher, effective tariff rates for the overall import basket of the things that we buy will be higher 6 months from now than they are today. Not as high as what was projected on April 2nd, the Rose Garden ceremony, but to put it in perspective, we're right now at our effective rate, we're at what, 3 times, a little more than 3 times what we were when we started this at the beginning of the year. And so it's meaningful. It's not economy destroying, it's not recession inducing, but it's meaningful, and we're seeing it begin to creep into margins. So new reports out of margins, particularly at larger companies, being squeezed by the tariffs. We look at data, particularly from the Census Bureau, who does a pretty robust survey every 2 weeks of 200,000 businesses. You already see 50% of manufacturers, wholesalers, and retailers reporting the price they paid for goods and services in the last 2 weeks increased. What are they going to do with that? 40% in each bucket say that in the next 6 months they'll raise prices. So they're going to eat some of it, but some of it they're going to use to
Pass
raise
along
prices.
to the
And in our
consumer.
middle market business index survey for the second quarter, our survey respondents, about 2/3 of us told us that they intend to pass these along
Yeah.
downstream.
Yeah.
Right? So that's going to have a micro and macroeconomic impact. You know, on the macroeconomy, now had we stuck with those April 2 levels, we would have had a recession. We would have had it.
Yeah.
The Trump administration, in my estimation, beat a rational retreat to the point where we think we're going to see that economy slow from 3% growth at the end of last year to around 1.1% at the end of this year. And then the tax legislation gives us a boost. We think we get up to around 2.5% next year, and then we'll settle back towards trend around 1.8% in 2027. Unfortunately, that does approximate a stagflation light economic framework. But their intent on resetting the global economy, they were elected, it's their policies, and we'll see how it all shakes out. But that seems to me to be where we're at. 1% growth, 3% inflation, and an unemployment rate around 4.4%. Still mostly full employment, but the thing is, as we get in the next year, as the immigration crackdown's fully funded, we'll want to watch that closely. I would say that 2,000 to 3,000 people a day is not mass deportations. That's where we're at now, but we're starting to hear about some of the stress. Now, when that steps up, if you end up in that 1.5 to 2 million a level of deportations, okay, those are mass deportations. And then you start thinking about second order inflationary issues via the wage channel. There's not enough people. And we saw during the pandemic, when there wasn't enough workers, what happened? Wages begin to be bid up. Yeah, American workers will do that, and then we'll be talking about wage push inflation, and then you're talking about higher interest rates, right? I don't think that's a good place to go, but we'll see if that's where we end up in 2026.
And you're not anticipating a rate cut in July?
No, there'll be no, in my estimation, no rate cut in July. We get one in December. My estimation of the Federal Reserve is what we call reaction function. The optimal policy rate is 4.65 today. The current rate is between 4.25 and 4.5, so it's well positioned. We'll see how the evolution of the inflation data arrives. We always thought that the July, August, September, and October data were going to tell the tale of where we're going to be. If inflation does move towards 3% or 3.5%, Fed's going to have a very difficult time cutting rates, and that means more tension between the White House and the central bank.
How do you advise businesses to plan right now?
It's really hard, right? If you're affected by imports and tariffs, you, one, have to assume that uncertainty is the norm, but two, you have to have a trend line. We've been publishing reports that say exactly what we just discussed. Your expectation should be that these tariff levels are going to go up, not go down. And that creates some decision points for you, right? So right now, most businesses have not fully passed along the cost of the tariffs. Part of that's a hope that the tariffs go down. Part of it's a concern about market share that they might have. Part of it is the uncertainty about the macro economy, and they want to figure out how to navigate that. But as you begin to kind of settle into, okay, this is the range of what I think are probable outcomes, then you have a responsibility as a business to start thinking about where your margin is and figuring out how much pricing you can effectuate to your customers. And I think that's kind of what they're in the process of doing. The same thing on the workforce side, and you're seeing this. This is even in areas of the economy where you might have more softness. Employers are continuing the reluctance to let go of workers. That's probably the right thing to do, because you're looking at a situation in which the labor market is going to, absent some type of economic shock, get tighter as a result of these policies. And so you have to worry about where your workforce is going to come from. And if you let them go and you have to bring people back, what price you're going to be paying.
You know, the pervasive uncertainty around policy does carry a cost. Small and especially middle market firms crave certainty because they just lack the financial depth to respond to the never-ending changes, right? The game of extend and pretend the administration plays on trade. So when I talk to the clients, I'm telling them, look, this is highly unusual. You're going to have a certain elasticity around your balance sheet because mid-market firms just don't have the leverage to negotiate away those price increases upstream. You know, 20 years ago, there was about 200,000 middle market firms. After the great financial crisis and the pandemic, there's around 125,000 now. This is a market niche that's strong, right? However, the market has much larger revenues. That winner-take-all economy, the shakeout of the two great once-in-a-lifetime crises, ended up with the larger portion of the middle market really winning the game. Now that they're here, there's a little bit more room, but again, it's difficult to adjust to the never-ending whack-a-mole nature of tariffs. And it's causing, there's some tension. You can see the frustration. I did not vote for this. What is this? Can you please explain the rationality of this to me? Well, 90% of the mid-market participates in the global economy. They look at as a mutually beneficial set of interactions. Unfortunately, the decision makers in DC now do not see it that way. They see it as a zero-sum game, either I win or you lose, and we need to lift those rates. This is where we're at. And so it's a good thing that we've got a dynamic and resilient economy because it's absorbing those body blows and those headwinds to the point where we're going to avoid a recession. I have a feeling when we look back in 10 years, we're going to say, there were some really impressive things that we learned about the dynamic portions and the resilient components of our economy, and maybe we want to reinforce those to make this economy as resilient as we can. But nevertheless, we just think 1.1% growth is just where we're at this year.
Yeah, it's truly a fascinating time.
What Joe just described is a point we're trying to make to the administration and policymakers. Ironically, the bigger you are, the easier this is to navigate because you have the balance sheets, you have the financial resources. The smaller you are, and this is, if we have a particular area of concern, it's in the small business, not even mid-market, go further down, small businesses. A lot of policymakers in Washington say, well, they're on Main Street. They don't import. Well, the reality is that
everyone does.
We have 242,000 small businesses, according to the Department of Commerce, who directly import. Yeah. Many times that who are importing indirectly through a wholesaler. And so if you take the announcement earlier this week, we had 9 countries, Japan, South Korea, Cambodia, Indonesia, and if you look just at those countries, you're talking about around 70,000 American small businesses who import. And at the rates announced, if they take effect on August 1st, you're looking at a $27 billion tax increase annualized on those small business importers. And so the bigger guys, and there's a lot of big importers from South Korea and Japan, I'm not worried about them. I am worried about those small business importers.
As we should be. Investors really crave certainty, though. And how do we explain what's been happening with the markets? I think that there's such a disconnect there.
Well, the enhanced volatility is the way to describe it. There was a time a quarter of a century ago when the dollar started to unwind. It peaked in summer 2002, and volatility traders across the financial industry were very much in vogue because that's where you could make money in the big banks at the time. Today's a little bit different. We've made an outsized bet on the tech sector, fundamentally transforming the economy in a way that we've never seen before. And so capital is flowing into that. In many respects, it was a bet on the one big beautiful bill, the portions of the bill that favor investment, and then of course the regulation, a more favorable regulatory environment. And in some respects that's come true. But when you take a look at the trade situation, the laws of financial gravity cannot be defied forever. If profit margins are going to be thinned across the non-tech sector, those markets are going to have to adjust lower at one point. Second, the dollar is depreciated over 11% against a trade-weighted basket, 14% against the euro. That's going to add to inflationary risks going forward. So again, the market now, we're up about 6.5% on the S&P since the beginning of the year. Okay, that's pretty good given the volatility that we've seen, especially that 20% drop in April. But going forward, it's going to be about earnings.
Yeah.
Earnings are going to start here in a couple days, and we're going to see just how narrow those margins have already thinned because of tariffs, and then think about where tariffs are going to go whenever we think we've reached the point of clarity.
I resist the temptation to borrow from Alan Greenspan and call it irrational exuberance. It's not exactly irrational exuberance, but there's kind of a force of will when I'm watching the markets and kind of market commentators that the worst will absolutely not happen. In fact, it's not even close to the worst. We're gonna choose off ramps at every opportunity. We're gonna manage kind of through this, and I hope that's true. But you saw a little bit of this earlier this week. I don't fully understand why markets were necessarily surprised. Even the copper market this week surprised by 50% or the new tariffs. Like, it seems to me that we were just willing that wasn't going to happen, and then we get a little bit surprised when it does happen. I wish we were pricing in a little bit more of these risks, and then I think we would have a more stable market.
It's what's called the taco trade. Trump always chickens out. The market is a true believer in that for now, and as long as
it's a game of chicken.
That's right. That's right, and that's not what you want to see.
Yeah.
Right. I spent most of my life working with large companies in the financial sector. They can dynamically hedge risks around tariffs, right? I get why portions of the Fortune 500, especially the banks, are doing well. We've got a steep yield curve. They tend to capture the value when you've got a steep yield curve. And then given the dynamic hedging, they're going to do better than everybody else. But again, there's a broader real economy. And I think it's very important here, Gigi, that stock market in some ways has become unfortunately delinked from that real economy under current conditions. And it's important that we don't conflate the two. We could see that market melt up another 5 or 6%. We get double-digit gains this year. All the while we're growing at 1%.
Right.
Right. And then I wouldn't want to be in politics next year if that's what happens, because people are going to, those small businesses, they're going to say, wait a minute, this is not what's supposed to be happening, right?
It's a really interesting perspective. One of the goals is to increase manufacturing here in the U.S. That takes time. How do you see that actually unfolding?
Well, it is one of the goals. I think a better goal question is, what do we want to increase manufacturing in, right? And so,
rare earths.
At the rare earths processing, in particular, it's the processing of rare earths that China really has a stranglehold over. The actual mining is not that terribly complicated. We can fix some permitting. We do need some investment in processing. That would make sense, and some of that is heavy capital investment and kind of technology driven on the processing side. Advanced semiconductors, advanced manufacturing, biomanufacturing. These are places where we ought to be excelling. What are we thinking about? I think our problem today is we're just saying we just want to make more stuff.
Yeah.
Do we really want to make more shoes? Do we that is not a high-end kind of profitable. The price that we would pay for a pair of shoes to domestically source shoes or other clothing items.
To find the workers who want to do that.
And find the workers. And so I think we need to be a little bit more strategic than just saying we just want to manufacture whatever it is here, because we've done really well moving up the manufacturing chain and moving into services. I don't know that we want to deleverage from services and go back down the manufacturing chain. That's not the path to prosperity. And so what we should be focused about is the quality of living of the average American, and the quality of living of the average American is improved when we are doing more advanced manufacturing, when we are more of a service side of the economy, and we have the ability to import the other goods that we want at a lower price.
Up the value chain, 3 things. Targeted industrial policy, like what we're doing in semiconductors in Arizona and Texas. 2, multilateral cooperation within North America, specifically with our friends in Canada, to get those rare earths extracted. 3, stay away from attempts to repatriate low value added manufacturing. You're going to fail, you're going to waste taxpayer dollars. That's just not where it's at. Moreover, we don't have the labor supply to do it. I mean, if you think about, you think that we want to repatriate these? Well, the logic would be to open the border and let people come across, but we're doing the opposite. So my sense is that's a lot of talk. And what we're going to fall back on after this experiment is targeted industrial policy, which I think, given real concerns around defense and infant industry, think artificial intelligence, think quantum computing, which is a big deal in central Texas where I live, right? Yeah, that industrial policy makes absolute sense. And then we need to have a discussion internally about resources, especially around rare earths. We have them here in the United States.
They're actually not that rare.
Yeah, we know where they are. We just have to decide to use it. And I think that's a good discussion to have that should receive bipartisan support at this point.
We can't talk about constraints in the labor market without talking about AI's effect.
Yeah.
And it can't just be negative. There are benefits to the labor market and how it will shake out because of AI. So how do you see that unfolding?
You know, Gigi, we've known each other a long time. You know, that first job I got in investment banking, first job that your guy got, we wouldn't get those jobs today.
They don't need them.
No, they're not there.
No,
No, you can pick your AI agent. What it can do is worth about an analyst that you'd pay $150,000 a year for.
Or a consulting firm.
Or a consulting firm. And the level of information, the data you can extract. I can now export my Excel data into an agent, which then can spit back data visualizations to me and conduct very sophisticated analysis. You guys know what vibe coding is? Y'all out there know what vibe coding is? Yeah, these are individuals who are becoming an expert on how to manage the artificial intelligence,
the prompts,
which then the AI then codes for you.
Yeah.
Okay, we're really advancing here. And it's good we're beginning to have this conversation around what this means and how to manage it.
This means a lot for graduates entering the labor market.
And it's becoming difficult for the cohort right now to find that first job because employers simply don't know what skills they need given the investment they're making in some very esoteric and very expensive technology. And this conversation's happening in real time.
Yeah, and we're gonna, I feel the worst for the cohort that's graduating kind of today, right? Because they were preparing for an economy and being prepared for an economy that's rapidly changing. We're also gonna begin quickly changing how we prepare the next cohorts who are coming along behind. And so, you know, probably no one was studying how to effectively be an AI prompter and figuring out how to master those skills 2 years ago, preparing to workforce. People are doing it now, and they're going to be prepared for those jobs. And so you're absolutely right. There's going to be some disruption. There's going to be dislocation, always are with technology. But ultimately, we're going to become much more efficient as a result of this. And we are going to move up the value chain. So we're talking about what we want to manufacture in the same way of the services we want to produce. We're going to move up the value chain in the services that we are able to produce at a reasonable price, and that's ultimately going to be good for our quality of life.
It's important that we don't get too dour here.
Yeah.
10 years ago, you know, my wife's a professor at the University of Texas. She teaches something called user experience. They produce individuals with these great skill sets. And 10 years ago, jobs started popping up called cloud engineer, right? It was the #1 job there for a couple years. We didn't even have a NAICS code for it at the BLS. And that's what's going to happen now with vibe computing. Yeah. Right? These jobs will appear out of nowhere, requiring different skills, and then we'll find that, we're gonna all move up the value chain together, but everybody out there has to make change their friend. Yeah. They have to improve and continuously advance their skill sets, and that includes old men who went to graduate school just like me.
My
That's
son's
why it's
in,
so important to discuss it and
Yeah.
not be afraid of talking about
Right,
it and
yeah,
figure it
totally,
out.
yeah.
my son's in high school, and his school, I guess 2.5 years or so ago, ChatGPT, firm rule, no one can use it, can't be downloaded on your computer, this is going to allow everyone to cheat, and we're locking it up. Today, they're helping you learn how to use these AI products to produce the work, and the way they're studying is different. And so, if that's happening in middle school and high schools for my son, I bet it's happening all over the country.
I want to go to audience questions because they're always really good. So anonymous questioner here asked, and we sort of touched on this, but this is more concrete. What actionable steps can Main Street businesses take to manage the trickle-down impacts of international trade and tariff decisions that they have little control over?
Well, make globalization your friend. Diversified supply chains, flexibility in your work process, and be acutely sensitive to who you hire and the skill sets that they bring with you. Those are the three things I think right now, as we're just sort of in the early stages of what we'll call the disruption of global trade. I think those are good things to keep in mind.
Yeah, exactly right. My advice would also be have a view. It doesn't have to be where the U.S. Chamber or where Joe or RSM think. You should have a view of what you think the policy is going to look like and what levers you would pull based on that policy largely remaining in place for, let's say, the next several years. And you can adjust that, but if you're sitting around waiting, like, well, I don't know, I don't know what's going to happen on August 1st. I don't know. Then you're going to be behind the 8 ball, and in particular, the folks who have greater resources to manage it, the bigger guys, are going to have a leg up on you. So I would have a point of view, and I would be managing to that point of view about what the future is.
And let me give you an hardcore example here. So let's say you import goods that feed into the servicing of the very popular Korean automobiles that many middle class and down market individuals buy. They like the gas, they like the reliability, they like the style these days. Okay, that's good. Korean-US free trade agreement, largely zero tariffs. Okay, that's not going to be the case. Assume a 10%, maybe 15%, and just get on with it.
Yeah. Or even higher. If you're on the parts, you're probably at 25.
Right. Yep.
And I would, if you were betting on the future of similar level of imports, I would expect some type of decrease in those imports. And so I would want to know what the average life of the vehicle on the road is today if I'm doing Korean, and I would want to begin thinking about whether I'm going to have to move into some other area, whether people are going to really stop repairing their car and get a new one, depending on the price point of my repairs with a 25% tariff. And those are the things I'd be plotting out.
And I've got that ubiquitous Bloomberg terminal on my desk where I can see inventories, sales, life of automobiles. All of that information's out there in the public, but you as a business person have to be proactive and reach out. It's all there. Everybody wants to help. And we're just going through one of these unique periods, right, Neil, where it's just a lot of transition.
That's right.
You leave it to the audience to ask a question that we did not bring up, but is so important. How soon do you expect a drop in the value of the U.S. dollar, and how important is the impact of that?
It's incredibly important to me. This is the question. We've had a good 14-year bull run. It corrected for some of the pain from 2022 to around 2002 to 2010. The dollar's down 11% against the dollar index. The dollar index is down 11%. We're down 14% against the euro. My sense is that we're not finished yet, and there's going to be a lot more volatility. You know, I'm a strong dollar person. I think that ought to be the permanent policy of the United States. It protects loss of purchasing power on the edge. It helps with the fight against inflation. After a long period of disinflation, we're now in an era where the price of everything is just simply going to go up. It requires a different monetary policy, a different trade policy than the one we have, and it requires a strong dollar policy. But for right now, we have a de facto soft dollar policy. And this is going to, again, businesses have to adjust because you can't pass all of the prices along to consumers, right? You just can't. Moreover, when I go out and I go around the country and I talk to people who run businesses, they look at me sort of, dollar's always been strong. And there's just the institutional memory because of the last generation. It's just been lost. So we're going to learn some things again. We're going to rediscover some things again.
One anonymous questioner asked, why do you think finding workers is so difficult?
Well, 10,000 baby boomers are retiring every day. And so this is a Joe.
Largely they.
Yeah, I mean, that's a part of it. That's a big part of it. We did have people depart the workforce early. Particularly during COVID. Some of those have had the financial wherewithal, in part thanks to the stock market, not to have to return to the labor force. And so you combine those things together with basic demographics, and it's a problem. It's also true that we have a relatively strong economy, so we are trying to hire. People are trying to hire, and so you combine that tight supply of workers with increased demand, and this is where you end up. The part that we're going to, though, and you alluded to this earlier, and Joe mentioned, 1.5 to 2 million workers. So there's a great misconception, particularly in Washington, but amongst our viewers, and in particular their HR departments know this well. There are, last year, let's put it this way, last year the federal government issued 3 million pieces of paper that gave people who did not initially enter the U.S. legally the permission to legally work. If you are an employer and you're following the rules, which is the vast majority of employers, your HR department looked at that piece of paper, said, federal government says you're good to work. I don't know what's behind it. I don't know whether you're a dreamer or you had temporary protected status or you're awaiting an asylum hearing, but the government has said you're good to work. The policies so far announced by the Trump administration would prematurely end about 1.6 million, we estimate, legal work authorizations for people who are legally working today. Now, they're all not going to leave on August 1st or September 1st, but you're going to see gradually that exit from the workforce. And we're already beginning to hear from employers who, worried about violating the law, are looking through their workforce and saying, well, you've lost your ability to legally work, and that becomes a new opening, and that person's not going to be able to go find a new job. And so, yes, it's the deportation numbers, but it's also what precedes that is this withdrawal of this legal piece of paper to work, and that's what we're beginning to see happen right now.
And I've thought for a long time the Achilles heel of immigration policy is an untested assumption that there's a reserve surplus of labor willing to step in and do those jobs. There's not. What you're likely to see is an acceleration of the integration of that sophisticated technology in a way that the political actors designing this policy simply aren't in touch with and fundamentally don't understand.
One thing we haven't talked too much about as we head into the close is the geopolitical risks that are surrounding us and potential impacts. We have decreased our dependence on foreign oil, and that mitigates that a little bit. But where do you see the biggest risks potentially right now?
Let's start with the good news. One of the reasons that it's not going to be the 70s is that we are not reliant, as we once were, on Middle East oil, and we can protect ourselves against some of those shocks. There are new things that we are reliant on. We talked about rare earth minerals and critical minerals. The driving factor for the handshake agreement between the U.S. and China recently was the inability of some of our manufacturing sectors to get the rare earth minerals that China currently has a monopoly on. And so there are other things that we are newly vulnerable to. And I guess the thing and that would be the thing I worry about the most, is things like that while not as broad as an oil embargo or an oil shock of the 1970s, can have downside unexpected consequences. The second thing, and this is much more to the macro, is despite this effort to kind of reconfigure the American economy, it's not going to reconfigure overnight. We are still living in a globalized, interdependent world. That will continue to be the case. We have benefited for quite some time now even at low growth in the US, of being growing faster than everyone else in ex-China and the industrialized world. We're now going to test that proposition a little bit, and I worry about global imbalances as a result of this attempt to remake the economy, and I worry about that spillover into our own potential growth in the near and medium term.
Since the mid-1980s, the U.S. in real terms, its economy's tripled in size. But our demand for oil, gasolines, largely remained the same and even down a little bit. Essentially, the goals that we set during the great stagflation of weaning ourselves off of external energy sources, we've done it. Yeah. We've accomplished something magnificent, but it still doesn't remove the risks, as we saw during the 12-day war. The initial surge in the price of oil, if that would have continued, would have caused a global issue. Fortunately, that ended. My sense is the geopolitical area, it's still more about Russia and Ukraine and about China and the conflicts in the competition that go on really are where that's at. But at least for now, we aren't seeing any unintended consequences from the disruption of the global economy that the administration is driving.
I think that's right, and it may play out in micro ways too. Yeah. We hear from companies, U.S. companies, who export services, think cloud services, data storage, processing to allies around the world. And allies around the world who used to not think twice about procuring that from a U.S. headquartered company are now saying, well, maybe in the same way that the U.S. didn't want to be reliant on foreign oil, maybe I don't want to be reliant on information technology or data concentrated, stored, subject to U.S. rules. Maybe I would like to have some of my own system. And so in our effort to remake what our economy looks like, we're causing other countries to have those questions. If they begin to pursue those policies, as there's some indication that they are, that ultimately hurts where we've had natural advantages, particularly in the technology, information, financial services space.
And what I like is I'm going to be able to take my agentic AI, where I have an infinite number of agents working for me, and solve my business problems. Yeah. Over time, I'm not going to have to rely on that outsourcing. I can bring that internal and use technology as a substitute for that external labor, which obviously will make us more productive, or reduce our costs and make our companies more profitable. So the incentive matrix is really changing at a very rapid, very rapid pace. But Neil's right, we want to watch to where those frictions are and manage them wisely.
You two are so knowledgeable, and there's so many people who make economic and legislative decisions who are watching right now. Before we close, what's at the top of your wish list of what you'd like to see get done? It's a great opportunity, right?
Be careful what you wish for with the disruption of patterns of trade and flows of capital. Remember that trade deficit may be large, but it balances to zero because we get inflows of capital, which we then invest so we can build, produce, and take risks. And that's a story that's not being talked about. It's the zero-sum game that they're all focused on. I win, you lose, I win. That to me is not the way forward.
There's no zero-sum game in trade, as Joe just described. By the way, you can't celebrate capital investments, and investments coming into the heartland of America from abroad without understanding that that was financed by a trade deficit. There's also no zero-sum game on the workforce side. And so if I could tell them one thing is stop this zero-sum thinking on trade, stop the zero-sum thinking on workforce. We actually need greater trade, and we need more people coming in legally to work.
Such salient advice for decision makers, investors, business owners, consumers, everyone. Joe Brusuelas, RSM's chief economist, and Neil Bradley of the U.S. Chamber of Commerce, thanks for joining us on The Real Economy.